Hey everybody, welcome back to my channel. The Economic Analyst here. I'm going to give you an update on China's economy, on what I'm seeing so far coming through the headlines in the news. So the big thing that's happening right now is that in the high yield corporate bond index, according to the Bank of America's high yield index fund for corporate bonds in China, the high yields have hit over 25%. Now, if you remember and you've been watching my past videos on China, it seems that when those index bonds hit around over 25% was my estimate there, that the Chinese economy would start to collapse. That would signal the credit bubble finally bursting. And this is evidenced by what happened in the U.S. because in the U.S. in 2008, our corporate bonds collapsed. Our economy collapsed into a recession when high yield corporate bonds hit about 22% on the index funds. So, when we go back to China in 2008, they did have corporate bonds spike up to about 30%, but at that time, the ratio of debt that was private to public was very low. It was about 20% corporate debt, and 80% of that debt was government debt. So even though corporate bonds on the high yield hit over 30% back in 2008, China technically did not go into a recession. Instead, because most of the debt was government financed and it was backed by the faith and credit of the Chinese government, China basically weathered the U.S. recession, or not the U.S. recession, but the Great Recession at that time. And actually came out and still grew. Now, they did pass some stimulus packages, so I have no doubt that their economy was feeling the effects of the Great Recession at that time. But on paper, at least, according to the reports of the GDP numbers that we get out of China, they didn't go into recession. Of course, those GDP numbers aren't really to be trusted. China is an authoritarian economy run by the Communist Party there. The government statistics aren't really to be trusted there. They're not very reliable. However, from what we can tell, China did not sustain the blow that Europe and the U.S. did during 2008. Well, now their high-yield corporate bonds are over 25%. So now the question is there going to be a collapse now? My guess is possibly a definite possibility there. And the reason why is because the ratio of private to government bonds in China is much more indicative of what's going on in the U.S. and Western Europe. It's about, in the U.S., for example, 55% of our debt is government bonds, 45% is private. That's about the same of what's going on in China. China, I think, is 60-40, maybe 55-45, and same with Europe. So, now that they are much more exposed to the sensitivities that high yield bonds can suffer through high interest, because now, it's going to cause an outflow out of those private bonds for, all index funds. So that's definitely the danger there. Now, what I found interesting here is when we look at Bloomberg, which is updated on November 21st, their index bonds show that, the high yields hit 25%, but now they've dropped down to 20%. Well, what gives? What's happening here? Well, what's going on is that there's inflows of money going into these high yield bonds. In other words, investors are looking at it and saying, wait a second here, these high yield bonds, yes, they're risky, but they may not be as risky as what markets are expecting right now. There may have been too much of an overblown panic. I'm going to go buy into these funds. And according to Bloomberg, they're flowing into the ETF. So there are exchange-traded funds that are set up, particularly in Singapore, that hold these high-yield bonds. And this includes Evergrande. And this includes Evergrande, which was about to head into default earlier in September and October. And although they have missed bond payments, they have not actually completely defaulted on their debt. Part of this had to come that at the end of October, the Chinese authorities sort of clamped down on those companies and were like, say, you need to make your bond payment. So there's definitely some pressure from the Chinese government to say that they're going to pressure these companies to, at all cost, they're going to make those bond payments. But in my opinion, that's just delaying the inevitable. I do not think that because there's been this huge inflows of funding going on into those junk bonds that's going to save those companies, because that's not really what was causing the profit losses there. High interest may have something to do with it, but the reason why interest rates increase on those bonds to begin with is because the profit margins were not yielding what was expected based off those returns. Basically, the cash flows were not coming in. They were still too much oversaddled with debt. When interest rates climb like this and you see this huge escalation in interest rates, what that does is just escalate the collapse. It speeds it up. So these inflows may slow it down, but now it's becoming dangerous because now you've got even more investors piling in to already high-risk assets. And I also think that part of this has to do with record low interest rates that were set by expansionary monetary policies for Western countries. I think that because rates are so low here, it's forcing investors to look elsewhere, and one of those is the junk bond rates. After all, if these bonds do not default, if these companies do not default on their debt, then you can get 25% interest on your bonds, 20% per year. I mean, if you think about it compared to the stock market, which yields on average about 7%, although the stock market has been yielding record returns as of late. If you think about it, for the last 3 months, the U.S. stock market has not really yielded so much growth. And there's this 20%, 25% offering here for bonds that are, made look quite tempting. And I think that's what a lot of it has to do, is that there's a lot of yield chasing going on. And that's extremely dangerous because this is in a hugely risky market clamped down by an authoritarian country that went through a recession earlier in 2021. The New York Times reported that China's economy collapsed and contracted by 6.8% in the first quarter of 2021. So that's something that's kind of gone unnoticed, myself included. I didn't really even look at that, and that's been the first recession officially, first contraction officially that China has gone through since 25 years ago, at least on the actual authoritative records, that are printed out by the government statisticians. Again, take that with a grain of salt, but the fact that they even reported that the economy shrank by 6.8% in the first 3 months, that may have been what started this real escalation of those high yield bond interest rates. What I ultimately think, though, this is what I ultimately think about all of this, is that investors are gambling here. They're gambling that the Chinese economy will not let these companies default. They'll bail them out. Okay, they're going to buy their debt, or they're going to nationalize the companies, or at least buy some of their equity and pump money into it and prevent them from failing, in an attempt to prevent the economy from failing. We did a lot of this with the banks in the U.S. in 2008. There was a lot of bailout packages, and I think that that's what they're betting on, is that there's going to be a bailout, which means that, with government insurance, that these companies aren't going to fail. They're going to buy into these bonds and hopefully yield the returns. Now, there's an extreme danger to this, because one of the things that happened was that John Corzine, who headed MF Global, he was a U.S. senator, he made a bet that in 2010, Greece would not default on its bonds, and those were government bonds. He was counting on that the IMF and the Eurobanks would not allow Greece to fail, that they would provide emergency loans to Greece, and that it would keep Greece's government afloat and those bonds afloat. So he bought a lot of those Greek bonds, and it actually caused MF Global to collapse because, as we all know from history, Greece ended up collapsing despite that. So, the bets here are extremely risky, that's going on right now. From what I can tell, though, that looking at the fact that we tipped at that 25% and we've dropped down to 20%, I'm not ready to call it yet that China is facing a real estate bust completely. That's because the data that we're getting out of China is just sparse, and I don't have access to the tables and strata of data that I do with the U.S. through a reliable statistical database. And so, right now I'm just looking at the news and reading into this. But right now, a lot of ETFs, a lot of bond funds are going in and betting that China is not going to collapse in the real estate markets. They're buying these ETFs, bond funds, and maybe they'll make a killing out of this. But it's extremely risky, and that's something that we need to watch in the coming months. I would say that in the next 6 months to a year is going to be a critical moment for China. If these junk bond yields do not start dropping and say get below 15% in the next 3 to 6 months, I would say that we're still looking at a systemic collapse in the Chinese markets there. That the markets have not stabilized, nor are they returning to normalcy. And again, and obviously, my threshold was that if it hit 25% and stayed above it, then yeah, that's signaling a collapse in the Chinese markets. What did we get? It touched 25%. So, I can't really say that this is telling us that it's going to collapse, but it's definitely something to look into. And I'm going to keep an eye on this. I want to see what's going to happen in another month, whether we're going to get, is this going to be a dead cat bounce, and if this is going to start causing the bonds to drop more as the risks start to hit in, and especially as we go into the winter country. So keep an eye on that right now. One thing to note is that as far as the Yuan's currency is concerned, it's remaining remarkably stable right now. It's actually appreciated against the U.S. dollar in the last year, and while you might think that that's because the U.S. dollar has been depreciating, and no doubt it has, it's been, all currencies have been depreciating here. But when we take a look at the U.S. dollar compared to a basket of currencies, that includes the yuan in this basket, although it's a very small component. The bigger components are the euro and the yen. You can see here that the U.S. dollar index for the last 6 months has actually appreciated against those currencies. So there's a lot of capital inflows going into the dollar index and into dollar-denominated assets and dollar-denominated debts here. Basically, a lot of people are buying our bonds, probably the government bonds, especially due to the global slowdown in the economy and the reemergence of COVID going on. So the fact that China's yuan has remained stable against the U.S. dollar, which is the world reserve currency, is testament to the fact that China's economy, at least for now, is remaining stable. I think one of the things that we'll note here is that if we start seeing the yuan devalue very sharply, that will signal that the economy is unraveling as price inflation starts to set in. Now, one of the things that can happen from a credit bubble burst is an appreciation in the currency, because essentially debts are being dropped and they're being liquidated versus the extent amount of cash. So, the problem doesn't become that there's too much money in the system. The problem becomes that there's too little in face of the asset valuations, and those assets valuations start to drop, which means that the currency appreciates because now all prices are becoming cheaper in that currency. Now, we might be seeing that, and that may have been causing what this run-up in the appreciation of the yuan currency is that we're beginning to see the beginnings of a credit bubble burst in China, but it's difficult to tell on that. It really is. One thing's for sure is that, at least as far as global markets are concerned, investors are not concerned that China is going through record inflation right now. If anything, is showing that the inflation rates are relatively stable in China. But, again, this is sifting through the tea leaves. So, guys, I'll keep you posted on this. I'll give you more updates on what's going on in China. I'll probably create a playlist of the Chinese economy separately, so you can watch these videos as I update on them. I'll probably produce one once every 2 to 3 weeks on this as I keep an eye on it. Once again, guys, I thank you for watching this video. If you like it, make sure you click that like button, subscribe to my channel, so that way you can always keep track of what other information and data I pump out. And also, make sure you click that notification bell. Anytime I upload a video, you'll be immediately notified. And again, I'll talk to you guys next time.